Hey everyone, Mortgage Sensei here. Just want to talk today in regards to the secrets of being bankable when you're looking to buy a home. This is a really good one here. This is probably my bread and butter when it comes to getting people pre-approved. This is my understanding when it comes to how a loan works, what a lender is actually looking for, and taking proper risk assessment. So let's talk about it, right? What does it mean to be bankable, right? Being bankable means just what it says. A lender looks at your loan profile, they take a proper risk assessment, and they say, you know what, this person, we can bank on the fact they're going to be able to repay this loan. So, risk assessment is basically taking a look at the pillars, which we're going to cover in just a few, but taking a look at your different pillars in order to understand your credit and financial worthiness. So let's start off with number one, credit. I know I talk about this a lot. You're probably tired of me talking about credit all the time, but when it comes down to getting approved for any loan, it always starts out with credit. Um, if you need some help when it comes to credit, give me a call, shoot me a message. We can definitely help you get over the hump there, but credit is always number one. Number two has to do with your ability to repay the loan. We use ratios like DTI, which is a debt to income ratio. But basically, we take a look at, I call it cash flow, personal cash flow. We look at your cash flow after your gross income calculated come in versus your debts going out versus the housing payment go out. And it's going to come up with a percentage. And based off of that percentage, based off of the lender, based off of the program, a lender may consider you bankable or not based off of your ability to repay the loan. So income stability is a huge one. Number three has to do with liquidity. Liquidity basically means, source of funds. How much money you got in the bank or any cash value type of asset. No, we don't care about, the value of your boats, the value of your cars, even if it's paid off. It looks good on your net worth statement, but when it comes to getting a home loan, we only care about liquid cash. So the more money you got, now it doesn't mean you need to use your money. Because a lot of time I can structure a loan in a way to where you have very little money out of pocket. But at the end of the day, when the loan is closed and funded or going through the process and underwriting phase, the lender want to be able to look at you and be like, okay, I know how much money this person is bringing to the closing table, but I see how much money this person still has in their banking account or their cash value accounts. So if something happens to them financially, you get sick, you lose your job, things like this can happen. We know how much money they have in the bank where they can continue to make their payments and until they can get back, stable far as finding another job or, getting back healthy, getting back to work, COVID just happened, stuff like that. So that's what it means when it comes to liquidity. That's number three. Number four has to do with equity, right? This is directly dealing with the property in and of itself. How much is the home worth versus how big is the loan is. And that really has to do with purchases or refinances. Purchases do take in a additional factor is more of loan to purchase. This is your equity stance from the purchase agreement between you and the seller, and then what the actual loan amount is. So your down payment, right? That is a more of a heavy factor when it comes to purchases, but it's equity at the end of the day. The fifth one has to do with property type. Okay. Now, I know this sounds pretty, straightforward, but property type goes into not just the type of home you're getting, single family residence, condos, townhomes, modular manufactured homes, right? Those are all green light. Let's go, move forward. Of course, we're not looking at any kind of trailers, mobile homes that's with access wheels. It can be picked up and moved. Tiny houses that's not on a permanent foundation or doesn't meet minimum county or state requirements, right? So the type of property you get is important, but also the grading on that property, right? Meaning, what is the quality of the home, right? What's the life expectancy of the roof or the foundation, or is there any damages or anything along those lines, right? That could be a determining factor on whether the bank will lend you money or not. So property type is its own category. And then last but not least has to do with the program. Now, the program, normally you want to be matched up with a program that fits your financial situation and your financial goals, but there are situations where people try to go with a program that they just won't qualify for. For instance, and this is just a hypothetical, but for those that's looking for down payment assistance programs, well, some down payment assistance programs have a minimum credit score requirement or a maximum income limit requirement or a property type requirement, right? That may make you ineligible to move forward with that type of program to be bankable, but it doesn't mean you don't qualify for a different program that will meet your financial situation in order to be bankable when it comes to lending. This is Nelson Thompson, aka the Mortgage Sensei here, powered by Edge Home Finance. If you would, please like, subscribe, follow, join my other social channels. Drop me some comments. Let me know what you want to hear, what you're interested in, what you're running into. That way I can make a video specific for that and help everyone get on the other side of home ownership. I'll see you again soon.